When many new traders look at a price chart, all they see are confusing candles, red, green, sometimes rising, sometimes falling. But what professional traders see is completely different. They read the structure behind those candles, what we call the market structure, because the most reliable way to understand where price is heading, catch reversals, and follow trends is through this structure. Today, we'll go over the core concepts of market structure, especially BOS, CHoCH, and other trend reversal terms in detail. If you truly understand these, you'll start seeing the market from a completely new perspective. So if you're ready, let's begin after the intro. First, you need to know this. The market is actually a reflection of human behavior, crowd psychology, greed, fear, and patience. All of these emotions are hidden inside price, but we decode those emotions by reading how the candles line up. That's where market structure comes in. The highs and lows in price tell us the trend's direction and strength. To identify an uptrend, simply check this. Is every new high higher than the previous one? Is every new low also higher than the previous one? If so, that's an uptrend. Likewise, if each high is lower than the last and each low is also lower, that's a downtrend. It starts with this simple logic, but as we go deeper, terms like BOS, CHoCH, and MSB appear, break of structure. This concept is one of the strongest confirmations that a trend is continuing. Imagine the market is rising, price keeps making higher highs. But how do you know if it will really continue? When price breaks above the previous high, that's a break of structure. It tells us the market is still bullish, buyers are in control. The same applies in a downtrend. If price breaks below the previous low, that's a BOS and confirms continuation of the bearish trend. In short, BOS is a structural break that confirms trend continuation. But the market doesn't always move in one direction. Sometimes it wants to reverse. That's when change of character comes in. CHoCH is the first sign that the market's direction may be changing. For example, in an uptrend, we keep making higher highs. But if price suddenly drops below the previous low, what happens? The character of the trend has changed. There's now a possibility of moving from bullish to bearish. The opposite applies in a downtrend. If price breaks above the previous high, the bearish character has shifted, and the chance of a bullish reversal increases. That's why CHoCH is golden for many traders. It gives the earliest possible reversal signal. Of course, patience is key here, because a single break can be misleading. But when you combine structure with momentum, volume, and context, the signal becomes much more reliable. Here's a quick note. You might also come across terms like CISD, MSS, or MSB instead of CHoCH. While they differ slightly by time frame, for example, MSS often represents a short-term shift, while CHoCH indicates a higher time frame shift. The core logic is the same. They all represent potential market reversals. So you might see any of these labels used interchangeably. Now let's go deeper. One of the biggest mistakes beginners make is thinking that any small move is a BOS. But a true BOS must break a clear structure level. A small wick or fake breakout can fool you. That's why you must confirm BOS with candle closures, not just wicks. You need to see if price actually stays beyond that level. Otherwise, it might be just manipulation. The same rule applies to CHoCH. Let's say we're in an uptrend. Price pulls back slightly and wicks below the previous low. That doesn't necessarily mean CHoCH. If the candle didn't close below that level, it might just be a liquidity grab, the market collecting stop losses before continuing upward. So to confirm a real character change, look not just at levels, but also at candle closes, volume spikes, and the price's follow through. That's where professional traders separate themselves from amateurs. Let me give you an example. Suppose price goes from 20,000 to 25,000, clear uptrend, making higher highs. It forms a low at 24K, then rallies to 28K. But later, price falls back below 24,000. That's a CHoCH. The character starts shifting, but you shouldn't open a short immediately. It's just the first signal. If price keeps falling to 23,000, then 22,000, making lower lows, that's confirmation that the trend has truly reversed. Now, another scenario, you're in a downtrend. Price keeps making lower lows, BOS levels are clear, but suddenly price breaks above the previous high. That's a CHoCH. The downtrend is now in question. If price continues to make higher highs afterward, then yes, the trend has officially flipped bullish. When you use these structures together, they become your compass in the market, showing you exactly where you are. Here's a very important note. BOS and CHoCH don't always appear the same way across all time frames. For example, on the daily chart, you might see a BOS, while on the hourly chart, there's a CHoCH. That's why you need to establish time frame hierarchy. Professional traders start from the higher time frame to find the main structure, then drop to lower time frames to look for entry opportunities. If the daily trend is bullish, you shouldn't panic over a bearish signal on the hourly. It might just be a short-term pullback. But if both daily and hourly point in the same direction, that's when the setup becomes much stronger. Understanding this reduces your risk significantly. Also, you should never view BOS, CHoCH, and MSS in isolation. Always think of them together with liquidity zones and support resistance levels. These structures often form around key price areas. For example, on a USD/JPY chart, price approaches a strong support zone and a CHoCH forms there. That's a powerful bullish reversal signal. Or if a BOS happens at a major resistance, that's confirmation that the bullish move will likely continue. So never analyze market structure out of context. Keep in mind the market doesn't always form clean, textbook structures. Sometimes BOS and CHoCH overlap, creating confusion. In those cases, patience is your best tool. If the structure isn't clear, don't trade. The secret of professional traders isn't just knowing where to enter, but also knowing when not to enter. Patience is golden. Another key point, BOS, CHoCH, MSB, and CISD aren't always enough on their own. When you combine them with volume, price action, or even RSI and other indicators, your signals become far stronger. But remember, the core is always market structure, because every indicator is just a derivative of price. Price moves, first indicators follow. So, if you want to truly understand the market's language, you must first learn market structure. If you found this video helpful, don't forget to like and subscribe to the channel. See you in the next video.